What if I told you the richest people on earth don't live on salaries, don't sell their assets, and barely pay taxes the way you think they do? What if I told you that while most people fear debt, the ultra-wealthy build their entire lifestyle on it? Mansions, private jets, luxury cars, business expansions, not paid with cash, but with loans. Sounds risky, right? Sounds irresponsible. But here's the mystery. If debt is so dangerous, why does it make the rich richer, while it keeps everyone else trapped today? We're uncovering the hidden financial strategy known quietly among elites as buy, borrow, die, a system so powerful it reshaped modern wealth and so misunderstood that most people never even realize it exists. And the shocking part, you interact with this system every day without knowing it. Stay with me, because by the end of this video, you'll see money, debt, and rich living in a completely different way. Let's start with what you were taught. From childhood, the message was clear: avoid debt. Save your money. Work hard, earn income, buy things when you can afford them. Debt was framed as dangerous, something that ruins lives, something that puts families underwater. And for most people, that's true. Credit card debt destroys households, payday loans trap workers. Mortgages become financial chains. But here's the uncomfortable truth: there are two types of debt in this world, one that makes you poor, and one that quietly builds empires. The difference isn't the interest rate, it's who controls the assets behind the loan. This is where the story really begins. To understand how the rich live on loans, we need to go back to the roots of banking and aristocratic wealth in Europe. Hundreds of years ago, kings and nobles didn't sell land to fund wars or palaces. They borrowed against it. Land was power. Assets meant influence. Selling meant losing control. So instead, elites pledged their property as collateral. Banks gave them money. They kept ownership. And when values rose over time, their wealth quietly multiplied. This mindset carried forward into modern capitalism. By the early 20th century, industrial tycoons like Rockefeller, Carnegie, and Vanderbilt understood something critical: if you sell assets, you trigger taxes and lose future growth. If you borrow against assets, you get spending money without giving up ownership. That single idea changed wealth forever. Fast forward to the modern financial system. Here's how it works in simple terms. A wealthy individual doesn't hold most of their wealth in cash. They hold it in stocks, businesses, real estate, private equity, intellectual property. These assets grow in value over time. Now, instead of selling them to buy a mansion or fund a lifestyle, they walk into a private bank and say, "I own billions in appreciating assets. Loan me money using those as collateral." The bank agrees because the risk is low. Now something magical happens. They receive millions in cash. They keep their assets. They avoid selling. They avoid capital gains tax. They just turn wealth into spendable money without shrinking their empire. This is the engine behind elite lifestyles. Let's break the logic. When regular people need money, they sell time for wages. They get taxed immediately. They spend what's left. When the wealthy need money, they borrow against assets. Loans are not taxed as income. They keep ownership. That single difference creates a massive wealth gap over decades. Because while you work harder to earn more, their money works harder without effort. And it doesn't stop there. In the 1980s and 1990s, financial markets exploded. Stock prices soared. Real estate values climbed. Credit became cheap. This created the perfect environment for the wealthy. They discovered something powerful: if asset growth is higher than loan interest, borrowing becomes profitable. Example: if your stock portfolio grows 10% annually and your loan interest is 3%, you're effectively earning money by borrowing. This flipped the old debt narrative upside down. Debt stopped being a burden. It became leverage. And leverage is how billionaires scale wealth fast. This is why you see headlines about CEOs and tech founders living on loans instead of salaries. They don't need paychecks. They have appreciating assets doing the heavy lifting. Let's look at the behavior pattern, not the names. Top founders, hedge fund managers, and investors all follow the same blueprint. Step 1. Build or acquire assets. Step 2. Let those assets appreciate. EP3. Borrow against them. Step 4. Use loans to fund lifestyle and investments. Step 5. Repeat. They don't liquidate wealth. They circulate leverage. This is how you see billionaires buying yachts without selling stock, not because they're reckless, but because the system rewards asset ownership far more than labor. Now here's a part most people never hear. Banks don't treat everyone equally. If you have stable assets, massive collateral, political and institutional trust, you get access to ultra-low interest rates, flexible repayment terms, special credit structures. The poor borrow at high interest, the rich borrow at bargain prices. Debt becomes cheap fuel for the wealthy and expensive chains for everyone else. That's not accidental, it's structural. At this point, you might be thinking, this sounds unstoppable, infinite borrowing, infinite wealth, but here's where the story takes a darker turn. Because leverage cuts both ways. When markets rise, the rich accelerate upward. When markets fall, everything becomes fragile. Asset values drop, collateral shrinks, banks demand repayment. This is where financial crises are born, and this is exactly what we're about to explore next. Because the same strategy that made elites powerful also planted the seeds of global crashes. The wealthy don't sell assets, they borrow against them. They turn ownership into endless liquidity. But every system built on leverage eventually faces one question: what happens when the numbers stop going up? Because asset prices don't rise forever. Markets don't stay calm. And debt, no matter how smart, always demands repayment. This is where the story enters its most dangerous phase. Leverage amplifies gains and magnifies losses. When asset prices rise, borrowing feels safe, but when markets crash, everything reverses fast. Here's what happens behind closed doors: stock prices fall, real estate values decline, collateral weakens, banks suddenly see risk, they issue margin calls, they demand more money or force asset sales. This chain reaction creates financial panic, and history has shown this again and again. The 2008 crash is the clearest example of what happens when the debt-based wealth machine overheats. Before the collapse, banks handed out loans easily. Real estate prices skyrocketed. Investors borrowed aggressively to expand portfolios. Everything looked strong until it wasn't. When housing prices started falling, leverage turned toxic. Borrowers couldn't repay. Banks held collapsing collateral. Credit markets froze. Trillions in paper wealth vanished in months. But here's the shocking twist. While millions lost homes and jobs, the biggest asset holders didn't disappear. They were rescued. Governments stepped in. Central banks printed money. Interest rates dropped to near zero. Financial institutions received emergency support. Why? Because if asset markets collapse completely, the entire system collapses. And who owns most assets? Not workers, not retirees, not middle-class savers, the wealthy elite. So the system is designed to protect asset prices, even if it sacrifices purchasing power, wages, and savings. This is why after every major crash, stock markets recover faster than wages, housing prices rebound while renters suffer, wealth inequality grows wider. Debt-based wealth doesn't die easily, it adapts. After every crisis, politicians promise reform. They talk about banking regulations, tax fairness, financial accountability, but here's the pattern. Rules tighten briefly, lobbying intensifies, loopholes quietly return. Why? Because the global economy now depends on asset-driven credit growth. Governments need rising markets to fund pensions. Banks need borrowing to stay profitable. Corporations need leverage to expand. So instead of fixing the system, they keep reinforcing it. The result? Bigger bubbles, more debt, higher risk. Now let's connect this story to today, right now. Global debt is at historic levels. Asset prices are inflated. Central banks have created massive liquidity. We see the same patterns: cheap borrowing, speculative investing, corporate debt expansion, housing affordability collapse. The wealthy are still borrowing against assets, still using leverage to fund lifestyles, still avoiding selling ownership, but the cracks are visible. Interest rates rise, markets shake, debt becomes harder to service. History isn't repeating exactly, but it's rhyming dangerously close. Every time this cycle plays out, one outcome remains consistent: the rich get richer. The middle class gets squeezed. Why? because those with assets benefit from bailouts, stimulus, and market recoveries. Those without assets face inflation, job instability, and higher living costs. Debt-based wealth concentrates power upward, and that concentration shapes politics, housing markets, and economic opportunity. Now we return to the strategy we teased at the beginning. Buy, borrow, die. Here's what it means. Buy appreciating assets, borrow against them to fund life. Never sell, pass assets to heirs. In many systems, inherited assets receive tax advantages, so the wealthy avoid capital gains tax entirely. Debt gets wiped out by estate planning. Wealth transfers quietly across generations. This isn't accidental, it's legal design. This is how dynasties form without ever cashing out. At this point you might ask, why can't everyone do this? Because the strategy depends on three things most people don't have. 1. Large appreciating assets. 2. Access to cheap institutional credit. 3. Long-term financial stability. Without these, borrowing becomes dangerous instead of powerful. For average earners, debt is consumption-based. For elites, debt is investment-based. Same tool, different outcome. Let's break this entire story into 3 clear lessons. The rich don't depend on paychecks. They depend on assets. If you only earn income and don't own appreciating assets, you stay trapped in the labor cycle. Ownership changes the game. Debt isn't good or bad. It's leverage. Used wisely with assets, it multiplies wealth. Used blindly for consumption, it destroys futures. Understanding this difference is financial literacy at its core. Modern capitalism protects asset values more than wages. This means those who own property, businesses, or investments benefit structurally, while those who don't fall behind over time. Ignoring this reality keeps people financially blind. Here's the uncomfortable truth: the debt-driven wealth model only works while markets grow. When growth slows, when debt becomes unpayable, when asset bubbles burst, the consequences don't stay contained. They spread through jobs, housing, retirement funds, and currencies. And the bigger the system gets, the harder the fall becomes. So here's the question no one likes to ask: if the rich are living on loans, and governments are protecting asset prices, and debt keeps rising globally, who eventually pays the bill? Is it future generations? Is it the middle class? Or is a major financial reset unavoidable? The answer isn't simple, but the pattern is clear. If this opened your eyes, don't keep it to yourself. Like this video so the algorithm pushes financial education forward. Subscribe if you want more deep breakdowns on money, power, and hidden economic systems. And comment below. Do you think this debt-based wealth system is sustainable or headed for collapse? Because understanding how the rich live on loans isn't about copying them blindly. It's about finally seeing the rules of the game you've been playing your entire life without being told.